All right, so Jim, we've got a story that we want to talk about that is related to finance. We got Dan and Sharon, 52 and 49. Dan is uninsurable. That actually hits some of us. Sharon is preferred non-smoker. Dan was had an insurance policy, but he was unsatisfied with the performance, and he didn't want to continue paying the premium. But with a collaborative effort with his financial planner and Jim Crone,
there you go.
He was able to get in there. You came up with a solution for him so that he didn't lose some sort of coverage, right?
Absolutely. I have to say, and Peter, you might have some comment about this, but what happens most of the time that I've found is that it starts with a basic question from a client or to a client from an advisor that says, hey, why do you have this? That's probably one of the more common ways to get the whole process started.
A simple question.
It's a simple question. What answer came from that question in this particular case was, gosh, I don't know. Well, he then dug a little deeper. It was a well-known mutual whole life company that the policy was whole life policy that was put in place. And normally when you put something in place, the original objective, as we learned, was to build up cash value and then use some of that in later years as a supplemental retirement income stream.
Sure.
Because you could take advantage of tax arbitrage that way. We've done those.
So
we've
it's
seen
tax-free when you pull it back out after you put it into the policy.
And normally when we construct those, there are preferred policies that I have, but more importantly, the structure of the policy is most important. And that is you're trying to get minimal death benefit against maximum cash value. So whatever their premium that they're comfortable with, in this case, his gentleman was paying some decent high premiums.
Yeah.
Paid it in for a number of years. He got into it and looked at it after probably 8 or 9 years and decided, gosh, this thing's not doing what I was originally thought it was going to do.
And by that, you mean it just wasn't gaining?
It wasn't growing
at
the level that he wanted to see. He recognized this isn't a stock, high-flying set of
this
circumstances.
Is more like a stable
fixed income kind of return.
Exactly.
But at the same time, he hadn't earned any money after all the years that he's paid all these premiums.
Sure.
And the biggest reason is because his death benefit was really high in relative terms. And that sucked up costs. It eroded the ability for that policy to grow well and so on.
So the suspense is killing me, Jim.
Where do you go from here?
What'd we do?
What'd we do? Yeah. Well, we did start on a path and started down. I tried to fix that to say, all right, if your objective is cash value growth, we can achieve that in a different version of a policy with a significantly lower death benefit.
Gotcha.
That was our original plan. Well, we started down that path and then come to find out that he was uninsurable. That's how we found out.
So you didn't know initially?
No. We learned that through the original process that we started with, just trying to solve on his life only.
And that means he had some sort of a health event.
Something came up in the medical evidence that suggests that we were not. In fact, we not only with the one company, we have the ability to source a lot of companies. And he was uninsurable across the board.
So what kind of events would occur to cause it? I would assume cancer.
Well,
right?
Cancer is one.
Maybe a heart issue.
Yeah. And it was an issue that he was aware of, but it wasn't described to him by his physician as something that was really need of having uninsurable.
Gotcha. So would this be worse than high blood pressure or diabetes? Is it going to be a bigger issue?
In fact,
than that?
I mean, this is rare, but I mean, there are conditions that clearly are uninsurable.
Are we going to go that deep, Jim?
Well,
I agree with that.
No, I think absolutely. It doesn't. I mean, you don't look.
I've lost all my hair. Does that?
Well,
help?
I mean, you don't have insurance for that?
No,
okay.
I would have bought it. I would have bought it if I knew that.
The other voice you hear is our own Peter Lynch, and we've been talking a little about insurance. Jim, you were laying out the details on a case study, which actually is a real-life situation where, we had a financial planner going through a situation where an individual had a life insurance. He asked him, so what is this for? It's a whole life insurance.
Right. well-known
contract,
company,
right?
existing
with a
policy.
well-known company. And as you went to make a transfer for a different purpose, kind of a pivot, if you will, you found out that the individual actually had a health issue that was uninsurable. So you were about to get into the juicy part of what'd you do now?
Well, the planner takes the opportunity, obviously, to say, okay, let's learn about this particular situation, and let's also figure out how to apply a strategy that's going to fit. Let's look for the higher good that could come out of this. And so the answers that evolved came from the client first by saying, gosh, I really am trying to think about my estate plan. And how do I take an individual product that I currently own in my estate and repurpose that to something that, now that I cannot be insured, how can I do something that covers both myself and my wife, which actually matches up with the way the estate tax is currently written, right? Estate tax is only applied after both individuals, a husband and wife, pass away.
Part of the end of that, I know we had gotten through, they had a policy, we weren't sure why, figured out that they were uninsurable, and is that where we are?
That's where we are, but I'm going to sort of pick it up and say, in the chats or in the conversations with the advisor, conclusions were drawn to say, gosh, this shifted his mindset from, gosh, he was a perfectly, in his mind, healthy. He still is a healthy person. He has some brain aneurysm stuff.
I see.
And it's a scenario that it could drop him like that, or he could live forever and no heaven. But it's the risk the insurance company is unwilling to take.
Yeah.
And we started to take in other input, right? He has his own attorney that he was working with, and we started down I laid out a couple of options. Hey, we could do an annuity to fund your life insurance. This life insurance, there's a particular type of policy called a survivorship, which actually puts two individuals on one policy. And what's unique about that, not only is the policy unique, but it does allow for one of those individuals to be uninsurable. That was the
okay.
That matches up with the facts and circumstances. It also matches up with the current estate tax law as it's written.
How rare is that there are contracts that'll allow that just by adding another
we use them all the
individual?
time.
Really?
Yeah,
Okay. So
it's more
husband
frequent.
and wife. Wife again was
Perfectly
healthy and everything's good.
Yep.
Husband was uninsurable, but in order to, I assume you included both of them.
Yes.
Okay, so they were the insurance.
So both of those individuals are on one policy, so they only pay out a benefit when both individuals pass away.
Okay.
So the insurance company views it as they've spread their risk.
I got you.
And so that's how that works. But we started to really kind of get stumped when we started to think about how do you take an individual product that has a large volume of cash value.
Sure. The whole life policy in this case.
How do you get it to work to fund a survivorship policy? And we got input. The attorney actually had a brilliant idea. He said, well, look, why don't we gift the current policy in all of its glory, gift it to a newly formed trust, and we use that to then fund. We actually pulled the cash from that and funded an income-generating annuity.
Okay.
So the income-generating annuity actually now produces the annualized income to pay for the life insurance.
Now, an income-generating annuity is just basically...
This one happens to be a little bit unique. Most of them you can just say, hey, there's a deposit of X, and it'll present an income of Y.
Right.
In this case, we have a $15,000 annual premium. The value that we had as a deposit was $335,000. That was the cash value. So that was a normal frame of how you look at a general income generating annuity.